Thank you for attending today's presentation. Today we're going to be covering Chapter 4 of my book, Financial Independence, Getting to Point X. This topic is going to be managing debt. Please take a second to read the famous quote on the screen. So in this chapter, we start out by asking a question. Do you maintain a zero balance on your credit cards? Maintain no other high interest rate loans? This is question number 1 in this chapter. The next question is, do you know whether you're paying the most favorable terms on your home or investment real estate mortgage, or any loans for that matter? Do you have the most favorable terms on that loan? Have you refinanced? Did you take advantage of low interest rates when they were lower in the early part of 2022? So those are going to be key questions, and we're going to address some of them in just a minute. But before I do that, I want to ask the simple question. Is there a difference between good debt and bad debt? Is all debt bad? And the answer to that is no. Some debt is necessary. So if you're going to buy a home to live in and you could afford that home and it's modest, clearly taking a mortgage out to buy that home, to put a roof over your head, that I would define as good debt. The other advantage is that the interest on that loan may also be tax deductible, so there's some tax advantages to doing that. As far as going to college is concerned, typically paying to go to college is considered good debt. When we cover that in more detail in Chapter 7, I'll go into a lot more about that. So it doesn't necessarily mean you need to spend $50,000, $60,000 a year on a college education, but we'll cover that at a later chapter. The simple point is that there's good debt and bad debt. The single worst debt you could have is credit card debt. And let me tell you why. I refer to credit card debt as the terminal cancer of finance, because it really will kill you financially if you accumulate massive amount of credit card debt. And truthfully, the only reason to have credit card debt is because you're living beyond your means. You're not following Chapter 1 of my book, Living Within Your Means. So if every day you're spending X dollars, but you're only bringing in Y dollars, at the end of the day, what's going to happen is you spent more money than you brought in. That will put you into debt. That is not the road to financial independence. That's the road to financial ruin. So if you're doing that, please go back, reread Chapter 1, follow those rules. Very important. The other problem with credit card debt is that credit card companies, they're generally not so generous. They're going to charge you high interest rates. They could range anywhere from 0%, those are the teaser rates just to get you in to start using that credit card, but they could easily go up to 12%, make a few late payments. Your credit card interest rate could easily be 20% or higher. There is no single worse way to hurt yourself financially than to accumulate high interest, non-deductible credit card debt. When I cover Chapter 11 of my book, I'm sorry, it's not Chapter 11, it's actually Chapter 12. It's called The Power of Compounding. In that chapter, I'm going to tell you how the power of compounding will get you to financial independence so much quicker. When it comes to debt, the power of compounding does just the opposite. It will ruin you financially so much quicker, and it'll be hard to get out of that mess. If any of you have put yourself in that position, again, read through this chapter, have some amazing tips and strategies that you could implement to help put you on the right road to financial success. So let me give you a quick example here. Let's assume you spent $8,000 on your credit card this year, and the interest rate is 22%, which is not unusual. Your monthly payment is only $150 a month, so most people say, great, I could afford that. But what is that $8,000 really costing you is the question. The fact is that if you pay only the minimal amount each month, it's going to take you over 18 years to pay off that credit card debt. And at the end of the day, you're going to end up paying $23,430 in interest alone. That means that $8,000 really cost you somewhere around $31,000 or more. So at the end of the day, if you think you can't afford to buy something and it's not an essential need, then do yourself a favor, put down that credit card and don't use it. If you can't afford to pay it at the end of the month, simply do not pay for that with a credit card. Okay, so reducing credit card debt the old-fashioned way. Number one, stop using the credit card. Don't consider it as a way to actually pay for things. It's just a way to accumulate debt. Consider using a prepaid credit card, or even better, a debit card, so the money will come right out of your bank account. If you don't have the funds in there, chances are you're not going to use that debit card. Know who the enemy is, right? The enemy is that credit card. The temptation of spending money that you can't afford. Know who your enemy is and stay away from it. Reduce the interest rate you're paying on any loans that you have. If you're paying high rates on credit cards, speak to other credit card companies. They may allow you to roll that money over to them, even if they're giving you a 0% rate for a year. Take advantage of it. It'll give you some time to get caught up. If you have a mortgage, student loans, or any other type of loan, what you want to do is ask yourself, am I paying the lowest possible rate? If you're not, consider refinancing it. Set up a due date for repaying all your debt and stick to it. And again, once in a while, don't be so hard on yourself. Give yourself a break. So speaking of credit, we want to talk about a credit score. It's very important that you know what your credit score is. If you made some late payments, get back on track, pay those on time, because having a bad credit score is going to simply mean the likelihood of you being able to borrow money when it comes time to purchasing a home or buying a car, or whether it's going into business for yourself, there's a good chance you might not qualify for that loan. And if you do qualify, you may end up paying a much higher interest rate. So a good credit score should be 720 or higher. If yours isn't at least that, you should take steps to do that, take care of that. So what is the action plan when we're talking about managing your debt? Number one, become crystal clear about the difference between bad debt and good debt. Number two, if you have large balances in your credit card, make every effort to pay it off quickly as possible and maintain zero balance on those credit cards every month. If you have significantly high credit card debt, consider using cash from savings or investments to pay off those balances. If you have student loans, make every payment on time and make sure you maintain a good credit score. If you are considering buying a home, calculate carefully how much you can realistically afford to pay for that house. Do not overextend yourself. Only buy what you truly could afford. And you should request a copy of your credit report from the 3 credit bureaus. You get the opportunity to get that credit report from them for free once a year. It's important you get that annually, see what your credit score is, but more importantly, look through that credit report. If anything looks wrong, contact the company that it relates to, get that off your credit score. If you're accused of being late on something, that's going to affect your credit score. So really address that immediately as soon as you become aware of it, so your credit score could remain high. And the other important reason to look at your credit score at least annually is to identify any identity theft. So if someone's using a credit card or somehow took out a loan under your name, you want to know about that. That should come up in the details of your credit report as well. So that is the action plan when it comes to managing your debt. And of course, the last one there on the screen is making sure your credit score is at least 720. And if it's not, you're going to take the necessary steps to get that score there.